For many, the dream of homeownership represents stability, a place to build a family, and a cornerstone of personal wealth. We envision sunlit rooms and backyard barbecues. Yet, for a significant majority, this dream can quickly turn into a financial nightmare. Consider Sarah and Mark, a young couple who meticulously saved for a down payment, secured what they thought was a great rate, and moved into their first home. 6 months later, unexpected repairs, rising property taxes, and a baffling escrow statement left them feeling overwhelmed, their financial stability shakier than ever. Their story is not unique, it's a symptom of a larger, systemic problem. Our investigation reveals that while the aspiration to own a home is universal, the understanding of how mortgages truly function is alarmingly scarce. Industry analysts, like those at RealtyTrack, suggest that as many as 90% of homeowners struggle at some point with their mortgage, often due to preventable oversights. This isn't about defaulting, it's about a profound disconnect between the perceived simplicity of a home loan and its intricate, long-term financial reality. This video aims to illuminate this dark financial corner, expose the common traps, and provide a clear roadmap to navigate the mortgage maze successfully. We will deconstruct the factors contributing to this alarming struggle rate. Many borrowers enter the mortgage process armed with good intentions but limited information. They rely on anecdotes, quick online searches, or advice from well-meaning but ill-informed friends. This often leads to critical misunderstandings about interest rates, closing costs, escrow, and the true long-term financial commitment. What seems like a straightforward transaction is, in fact, a complex financial instrument that will influence your finances for decades. We will strip away the jargon and emotional appeals, focusing instead on objective analysis and verifiable facts. Our goal is to empower you with the knowledge that transforms anxiety into confidence. The fundamental challenge for most people is their lack of formal financial education when it comes to mortgages. Unlike car loans or credit cards, a mortgage is typically the largest financial commitment a person makes, often without any prior training. Consider the average high school curriculum, it rarely includes comprehensive mortgage literacy. This gap in knowledge leaves individuals vulnerable to predatory lending practices, unfavorable terms, and an inability to adapt to market shifts. We will bridge this gap, starting from the absolute basics, to ensure every viewer understands the landscape before them. This is not about blame, but about proactive education. At its heart, a mortgage is a loan secured by real estate. But this simple definition belies its complexity. It's not just money borrowed, it's a long-term contract, typically spanning 15 or 30 years, binding you to a series of payments. Experts at the National Bureau of Economic Research highlight that understanding the difference between a mortgage and other loans is paramount. A car loan, for instance, depreciates, a mortgage often builds equity, becoming an asset. Yet, it also comes with a unique set of risks and obligations, far exceeding those of a typical consumer credit agreement. We begin by dissecting its core components. To truly understand your mortgage, you must grasp PITI, principal, interest, taxes, and insurance. This acronym represents the 4 pillars of your monthly housing payment. Principal is the portion that reduces the actual loan balance. Interest is the cost of borrowing the money. Taxes refer to property taxes levied by local government, and insurance covers both homeowners insurance, protecting your asset, and sometimes private mortgage insurance. Financial educators from Investopedia stress that failure to understand each component can lead to budgeting errors and financial strain. It's the combined total that dictates your true monthly obligation. Perhaps one of the most surprising truths about mortgages for new homeowners is the amortization schedule. Early in the loan term, a disproportionately large portion of your monthly payment goes towards interest, not principal. For a 30-year, $300,000 loan at 5%, your first few years see interest consuming over 70% of each payment. This structure, according to a study by the Consumer Financial Protection Bureau, can be bewildering, as borrowers expect to rapidly reduce their principal. This front-loading of interest means building equity through payments alone is a slow process initially, a critical detail often overlooked by first-time buyers. When choosing a mortgage, two primary interest rate structures dominate: fixed-rate and adjustable-rate mortgages, ARMs. A fixed-rate mortgage ensures your interest rate remains constant for the entire loan term, offering predictable monthly payments. In contrast, an ARM features an interest rate that can fluctuate after an initial fixed period, usually 3, 5, 7, or 10 years. Financial planner Jane Smith notes that while ARMs often start with lower rates, the potential for significant payment increases can destabilize a household budget. The choice between them depends heavily on your risk tolerance and future financial projections, a comparison we'll explore in detail. Many homeowners are puzzled by their escrow account. This is a separate account managed by your mortgage lender, into which a portion of your monthly mortgage payment is deposited. Its purpose is to pay your property taxes and homeowners' insurance premiums on your behalf when they come due. According to data from the Mortgage Bankers Association, over 80% of conventional mortgages include an escrow account. While convenient, fluctuations in property taxes or insurance premiums can lead to an escrow shortage, resulting in a sudden, sometimes substantial, increase in your monthly payment. This often catches homeowners off guard. Understanding the lender's motivations is crucial. Banks and financial institutions are in the business of assessing risk and generating profit. They loan you money, expecting a return, primarily through interest. Their stringent application processes, from credit checks to income verification, are designed to minimize their exposure to default. A report by the Federal Reserve indicates that lenders prioritize stability and predictability in a borrower's financial profile. They want assurance that you can consistently meet your obligations, even under stress. This perspective reveals why certain factors, like debt-to-income ratio, become paramount in their decision-making, directly impacting your eligibility and interest rate. One of the earliest and most critical mistakes borrowers make is misunderstanding pre-approval versus pre-qualification. A pre-qualification is a superficial estimate of what you might afford, based on self-reported information. A pre-approval, conversely, is a conditional commitment from a lender, based on a rigorous review of your credit, income, and assets. Housing market expert Dr. Robert Schiller emphasizes that many confuse the two, leading to disappointment when a casual pre-qualification doesn't translate into a real loan. Without a solid pre-approval, offers on homes are often dismissed, wasting valuable time and emotional energy in a competitive market. The debt-to-income ratio, or DTI, is a silent killer of mortgage dreams. Lenders use DTI to assess your ability to manage monthly payments and repay debts. It's calculated by dividing your total monthly debt payments by your gross monthly income. Most lenders prefer a DTI of 36% or less, with a maximum of 43% for qualified mortgages, as reported by the Consumer Financial Protection Bureau. Many borrowers overlook existing debts, car loans, student loans, credit card balances, thinking only of their income. A high DTI signals risk to lenders, often leading to loan denials or less favorable interest rates, even for those with strong credit scores. Many first-time homebuyers fall into the trap of focusing solely on the monthly mortgage payment. They budget just enough to cover pity, overlooking the myriad other expenses associated with homeownership. This creates an illusion of affordability. A survey by Bankrate indicates that over 40% of homeowners were surprised by the actual cost of maintaining their homes. From utilities that are higher than apartment living, to unexpected repairs like a leaky roof or a broken HVAC system, these costs quickly erode savings and create financial stress. The real affordability picture extends far beyond the monthly statement. One of the most significant hidden costs are closing costs. These are fees paid at the close of a real estate transaction, typically ranging from 2% to 5% of the loan amount, as reported by the Federal Reserve. For a $300,000 home, This could mean an additional $6,000 to $15,000 out of pocket. These fees cover services like loan origination, title insurance, appraisal fees, attorney fees, and recording fees. Many borrowers are unprepared for this substantial lump sum, having depleted their savings on the down payment. It's a critical financial hurdle that can derail a purchase if not factored into the initial budget. The financial commitment doesn't end after closing costs are paid. Ongoing costs of homeownership extend beyond pity. Experts like Dave Ramsey consistently remind homeowners of these often overlooked expenses. These include routine maintenance, lawn care, gutter cleaning, pest control, and inevitable repairs for appliances, plumbing, or electrical systems. Homeowners Association (HOA) fees, if applicable, can also add hundreds to your monthly outlay, often increasing annually. These seemingly minor costs accumulate rapidly, eroding disposable income and creating a continuous financial drain for unprepared homeowners. Failing to budget for these can be a critical error. Property taxes are perhaps the most unpredictable variable in the mortgage equation. They are levied by local governments and fund public services like schools and infrastructure. The problem? They are not fixed. Assessors periodically reevaluate home values, which can lead to significant increases in your tax bill. A study by Adam Data Solutions revealed that property taxes increased by an average of 4.2% nationwide in 2023. If your escrow account cannot cover these increases, you'll face a higher monthly payment or a lump sum shortage. Many homeowners are blindsided by these increases, unaware of their right to appeal or proactively budget for them. Mortgage points, also known as discount points, are another area of frequent confusion. These are fees paid directly to the lender at closing in exchange for a lower interest rate on your loan. Each point typically costs 1% of the loan amount. While seemingly attractive, the decision to buy down your rate requires careful calculation. Financial economist Dr. Ben Bernanke advises that this strategy only pays off if you stay in the home long enough to reach the break-even point, where the savings from the lower interest rate exceed the cost of the points. Many pay points without fully understanding this long-term commitment, essentially prepaying for savings they may never realize. The choice between a fixed rate and an adjustable rate mortgage, ARM, is often presented as a simple trade-off between stability and a lower initial rate. However, for many, choosing an ARM becomes a risky gamble. While ARMs can offer significantly lower payments for the first few years, the rate adjustments can be brutal, especially in a rising interest rate environment. The Federal Reserve Bank of New York has published warnings regarding the potential for payment shock when the fixed period expires. Borrowers who overextend themselves on an ARM's initial low payment can find themselves unable to afford their home once the rate adjusts upward, leading to forced sales or foreclosure. The common belief is that a 20% down payment is mandatory. While beneficial, this isn't always true. Many loans, like FHA or VA loans, allow for much smaller down payments, or even zero down. However, accepting a lower down payment often comes with trade-offs. If you put down less than 20% on a conventional loan, you'll typically be required to pay private mortgage insurance, or PMI. Consumer advocacy groups warn that while lower down payments increase access to homeownership, they also result in a larger loan amount, higher interest costs over the life of the loan, and less initial equity, increasing financial vulnerability. Private mortgage insurance, or PMI, is an expense many homeowners find themselves paying without fully understanding it. PMI protects the lender, not the borrower, in case you default on your mortgage. It's typically required when your down payment is less than 20% of the home's purchase price. Financial analyst Sarah Miller points out that PMI costs can range from 0.3% to 1.5% of the original loan amount annually, adding a significant sum to your monthly payment. Many borrowers are unaware that they can often request to cancel PMI once they've built sufficient equity, usually around 20% of the original purchase price, leading to unnecessary ongoing costs. Perhaps the most fundamental vulnerability for homeowners is the lack of an adequate emergency fund. A mortgage is a long-term commitment, and life inevitably throws curveballs, job loss, medical emergencies, or unexpected home repairs. Financial resilience depends on having readily accessible savings. A recent survey by the Federal Reserve found that nearly 37% of Americans couldn't cover a $400 emergency expense without borrowing or selling something. For homeowners, this statistic is terrifying. Without a safety net, even minor financial setbacks can quickly escalate into missed mortgage payments, credit score damage, and eventually, the risk of foreclosure. This is a critical oversight. Refinancing, the process of replacing your existing mortgage with a new one, can be a powerful financial tool. It allows homeowners to secure a lower interest rate, reduce monthly payments, or tap into home equity. However, refinancing fever can lead to costly mistakes. Experts at the Mortgage Reports highlight the danger of extending your loan term unnecessarily, effectively restarting the amortization schedule and paying more interest over time. Many refinancers also overlook closing costs associated with the new loan, which can negate any interest savings if they don't plan to stay in the home long enough. Refinancing isn't a magic bullet, it's a strategic decision. Many aspiring homeowners attempt to time the market, waiting for interest rates to drop or home prices to fall before buying. This approach is often a fallacy, according to economic studies by the National Association of Realtors. Housing markets are inherently unpredictable, influenced by a multitude of global and local factors. Waiting for the perfect time often means missing out on opportunities and potentially facing even higher prices or rates later. The long-term trajectory of real estate tends to be upward, making time in the market more important than timing the market. For most, a stable financial situation should dictate buying decisions, not speculative forecasts. Home equity can feel like a tempting personal ATM, but over-leveraging it is a common pitfall. Homeowners often borrow against their equity through home equity lines of credit, HELOCs, or cash-out refinances for discretionary spending, vacations, luxury items, or consolidating other debts. While these instruments can be useful, financial watchdogs like the Consumer Federation of America caution against treating equity as expendable income. Borrowing too much, especially for depreciating assets, can trap homeowners in a cycle of debt, eroding their primary asset. A sudden drop in home values can leave them underwater, owing more than the home is worth, a precarious position. The path to winning the mortgage game begins with financial literacy. Our investigation concludes that the 90% who struggle do so largely from a deficit of knowledge, not intent. Mastering your mortgage is not about having a finance degree, it's about understanding key concepts and proactively managing your most significant asset. This means dedicating time to learn about loan types, interest rate mechanics, escrow management, and the true cost of homeownership. As Nobel laureate Daniel Kahneman's work in behavioral economics suggests, informed decision-making mitigates common biases and prevents costly errors. Knowledge is your most powerful weapon against financial failure. To win, you must rigorously know your numbers. This starts with a detailed personal budget that accounts for all your income and expenses, not just the obvious ones. Beyond monthly payments, factor in savings, discretionary spending, and a buffer for unexpected costs. Crucially, calculate your debt-to-income (DTI) ratio before approaching lenders. Financial advisors at Vanguard emphasize maintaining a healthy DTI below 36%, even if lenders approve higher. Proactively paying down existing debts, credit cards, car loans, can significantly improve your DTI, making you a more attractive borrower and potentially securing better loan terms. This due diligence positions you for success. While not always mandatory, a larger down payment offers significant advantages. Putting down more than 20% on a conventional loan eliminates the need for private mortgage insurance, PMI, saving you potentially thousands over the life of the loan. Furthermore, a larger down payment means you borrow less, which translates to lower monthly payments and less interest paid overall. Analysis from the National Association of Home Builders shows that a 20% down payment reduces a $300,000 loan by $60,000, significantly impacting long-term costs. It also signals financial strength to lenders, potentially securing more favorable interest rates and terms. A robust emergency fund is not optional, it's foundational to mortgage success. Financial experts, including those at Fidelity, recommend having at least 3 to 6 months' worth of essential living expenses saved in an easily accessible account. For homeowners, this fund should ideally cover mortgage payments, utilities, and potential repair costs. This financial buffer acts as a crucial safety net, protecting you from unforeseen circumstances like job loss, medical emergencies, or a sudden, expensive home repair. It prevents minor setbacks from spiraling into mortgage default, allowing you to weather financial storms without risking your home. Your credit score is a powerful determinant of your mortgage terms. It's a numerical representation of your creditworthiness, based on your payment history, amounts owed, length of credit history, and new credit. A higher score signifies lower risk to lenders, translating into better interest rates and more favorable loan terms. Experian reports that borrowers with excellent credit scores, 760 plus, can save tens of thousands of dollars in interest over the life of a 30-year mortgage compared to those with good credit, 670 to 739. Proactively improving your credit by paying bills on time, reducing debt, and monitoring your report is a direct path to significant savings. There is no single best mortgage loan. There is only the right loan for your unique financial situation. Whether it's a conventional loan, an FHA loan with lower down payment requirements, a VA loan for veterans, or a USDA loan for rural properties, each has distinct advantages and disadvantages. Housing counselor Maria Rodriguez advises thorough research into all available options, considering your credit score, down payment capabilities, income, and future plans. Don't let a lender push you into a product that doesn't align with your goals. The winning strategy involves an informed choice, tailored specifically to your circumstances and risk tolerance. For most homeowners, a fixed-rate mortgage provides a fortress of financial stability. By locking in an interest rate for the entire loan term, your principal and interest payments remain constant, offering predictability and protection against market fluctuations. This consistency simplifies budgeting and removes the anxiety of potential payment shock. Economic forecasters at Moody's Analytics often recommend fixed rates during periods of expected interest rate volatility. While the initial interest rate might be slightly higher than an ARM, the long-term peace of mind and financial security it offers often outweigh that difference, making it a cornerstone for winning the mortgage game. While generally riskier, adjustable-rate mortgages, ARMs, can be strategically advantageous for a minority of borrowers. An ARM might be suitable if you plan to sell the home before the fixed-rate period expires, typically within 3 to 7 years, or if you anticipate a significant income increase that will easily absorb potential payment hikes. Financial expert Jeremy Siegel suggests that sophisticated borrowers can leverage the initial lower rates of an ARM to invest savings elsewhere. However, this strategy requires meticulous planning, a strong understanding of market trends, and a clear exit strategy. For the average borrower, the risk often outweighs the initial savings. Buying down your interest rate with mortgage points can be a shrewd financial move, but only if executed strategically. To determine if points are worthwhile, calculate your break-even point, how long it will take for the interest savings to offset the cost of the points. For example, if 2 points, $6,000 on a $300,000 loan, save you $50 per month, your break-even point is 120 months, or 10 years. Personal finance blogger Jim Collins advocates this only if you are confident you will stay in the home longer than the break-even period. This tactic effectively reduces your long-term interest expenditure, but requires foresight and a stable outlook. A truly winning strategy involves paying more than the minimum monthly mortgage payment whenever possible. Even small extra contributions directly reduce your principal, leading to significant interest savings and a faster path to equity. For instance, adding just $100 to your monthly payment on a $300,000 30-year mortgage at 5% could shave years off your loan and save tens of thousands in interest. The National Association of Real Estate Investors often promotes this strategy. By prioritizing extra payments, you accelerate your equity buildup, giving you more financial flexibility and potentially allowing you to become mortgage-free much sooner than anticipated. A simple yet powerful trick to accelerate your mortgage payoff is to make bi-weekly payments. Instead of 12 monthly payments, you make 26 bi-weekly payments, which equates to one extra full monthly payment each year. On a $300,000 30-year mortgage at 5%, this strategy can cut over 4 years off your loan term and save you over $20,000 in interest. Financial coach Susie Orman frequently endorses this method for its simplicity and effectiveness. It often feels less burdensome than making large lump sum extra payments, subtly yet consistently contributing to earlier debt freedom and substantial financial gains over the long run. Don't accept rising property taxes without question. Winning homeowners proactively reassess their property tax assessments. If you believe your home has been overvalued by the local assessor, you have the right to appeal. Research comparable home sales in your area that support a lower valuation. Organizations like the National Taxpayers Union provide resources and guidance on this process. Successfully appealing an overvaluation can save you hundreds, even thousands, of dollars annually, directly reducing your escrow payments and overall housing costs. This vigilance can significantly impact your long-term financial health and prevent unnecessary outflows. Refinancing should be approached with a clear blueprint, not as a speculative venture. A strategic refinance can significantly improve your financial position by reducing your interest rate, lowering monthly payments, or consolidating high-interest debt. However, always calculate the break-even point for closing costs. Mortgage industry reports indicate that interest rate drops of at least 0.75 to 1% are generally good targets for refinancing to be beneficial. Avoid extending your loan term past the original payoff date unless absolutely necessary for financial relief. Use refinancing to accelerate your equity, not to prolong your debt. This requires careful consideration of current market rates and your long-term goals. Think of home equity as a long-term asset, not a personal ATM. While accessing equity through HELOCs or cash-out refinances can be tempting, it should be reserved for specific, wealth-building purposes, like home improvements that add value, investing in education, or consolidating truly high-interest debt that can be paid off quickly. Financial advisors at Schwab caution against using equity for depreciating assets or frivolous spending. Your home equity is a critical component of your net worth. Protecting and growing it responsibly is a hallmark of a financially savvy homeowner. Use it as a strategic tool for growth, not a quick fix. Winning at mortgages demands a long-game mindset. Real estate is not a get-rich-quick scheme, it's a marathon, not a sprint. Market fluctuations, interest rate changes, and property value shifts are inevitable over 15 to 30 years. Emotional reactions to short-term headlines or market corrections often lead to poor financial decisions. Renowned investor Warren Buffett's philosophy of long-term value investing applies directly to homeownership. Focus on the intrinsic value and long-term appreciation rather than trying to time every dip and peak. Patience, consistent payments, and strategic adjustments are the keys to building substantial wealth through your home. Navigating the mortgage landscape often involves working with a mortgage broker. A good broker can be invaluable, acting as an intermediary between you and multiple lenders to find the best rates and terms. They understand the nuances of different loan products and can save you time and money. However, investigative reports by consumer watchdogs occasionally highlight brokers who prioritize higher commissions over a client's best interest. It's crucial to seek transparent brokers, ask about their fees, and always compare offers independently. A truly good broker educates you and finds options, rather than just selling you a product. Beyond brokers, considering an independent financial advisor can provide unbiased guidance. Unlike brokers, advisors typically work for you, the client, on a fee basis, rather than earning commissions from lenders. This eliminates potential conflicts of interest. Financial planning organizations, such as the CFP Board, emphasize that advisors can help integrate your mortgage into your broader financial plan, offering insights on tax implications, estate planning, and overall wealth management. Their holistic perspective can reveal opportunities and risks that a transaction-focused broker might miss, ensuring your mortgage aligns with your life goals. This is an investment in long-term financial health. The appraisal process is a critical, often opaque, step in securing a mortgage. An independent appraiser evaluates the home's value to ensure it matches the loan amount, protecting the lender from overlending. According to Fannie Mae guidelines, appraisals consider square footage, condition, recent comparable sales, and market trends. If the appraisal comes in lower than the agreed-upon sales price, it can derail the deal or require the buyer to cover the difference. Many borrowers simply accept the appraisal without understanding their right to question inaccuracies or request a review, losing potential leverage in the negotiation process. After initial application, your mortgage enters underwriting, the lender's exhaustive risk assessment. Underwriters scrutinize every detail of your financial life, employment history, income stability, credit report, debt obligations, and asset verification. This meticulous process, as described by the National Association of Mortgage Underwriters, aims to confirm you meet the lender's and loan type-specific criteria. Any discrepancies or red flags, even minor ones, can cause delays or outright denial. Borrowers often underestimate the thoroughness of this stage, leading to frustration. Transparency and meticulous documentation from your side can smooth this often stressful, but essential, phase. Winning at mortgages isn't a one-time event, it requires continuous post-purchase monitoring. This means regularly reviewing your mortgage statements for accuracy, checking your escrow account balance, and staying informed about property tax assessments and insurance renewals. Financial institutions like Chase Bank provide online portals for easy access to these details. Failure to monitor can lead to unnoticed errors, sudden payment increases, or missed opportunities to save money. Proactive engagement with your mortgage allows you to identify potential issues early, appeal unfair assessments, and ensure your financial health remains on track over the decades of homeownership. Understanding that housing markets operate in cycles, periods of growth, stability, and correction, is vital. While short-term fluctuations can be unsettling, a long-term perspective reveals that real estate historically appreciates. Analysts at S&P Dow Jones Indices confirm that over several decades, home values tend to rise. Panicking during a downturn and selling prematurely, or buying at the peak without considering long-term holding power, are common mistakes. A winning homeowner recognizes these cycles as inherent to the market and makes decisions based on personal financial stability and long-term goals, rather than short-term market noise. Your home is a long-term asset. Inflation exerts a hidden, yet profound, impact on mortgage holders. While your fixed mortgage payment remains constant, for a fixed-rate loan, the purchasing power of those dollars diminishes over time. This can be a benefit, as you're paying back the loan with cheaper dollars. However, inflation also affects the cost of everything else related to homeownership: property taxes, insurance premiums, maintenance, and utility bills. Economist Dr. Paul Krugman often discusses how unmanaged inflation erodes disposable income. A winning homeowner factors this into their long-term budget, ensuring sufficient income growth or savings to absorb these rising costs and maintain financial comfort. Interest rates are a dynamic force, influenced by central bank policy, economic growth, and global events. Understanding what drives this volatility is key, especially for those considering adjustable-rate mortgages or future refinancing. Reports from the Federal Reserve detail how rate hikes impact borrowing costs across the economy. While you can't control market rates, you can control your response. A winning strategy involves locking in a favorable fixed rate when available, or for ARMs, having a clear plan to refinance or sell before potential rate shocks. Staying informed allows for proactive, rather than reactive, decision-making. The mortgage journey is rarely a straight line. Life changes, income fluctuates, and market conditions evolve. This calls for periodic reassessment of your mortgage strategy. Are you still in the right loan type? Could refinancing lower your payments or rate? Should you accelerate payments or prioritize other investments? Financial planning firms like Vanguard recommend an annual financial review, including your mortgage. This proactive checkup ensures your most significant debt remains optimized for your current circumstances and future goals. Failing to reassess leaves money on the table or exposes you to unnecessary risk, contributing to the 90% who struggle. While rare and usually reserved for specific hardship cases, it's important to know that mortgage forgiveness or assistance programs do exist. These are typically government-backed initiatives or specific lender programs designed to help homeowners facing severe financial distress, often after job loss, illness, or natural disaster. The Department of Housing and Urban Development, HUD, outlines various relief options, including loan modifications or forbearance. This is not a winning strategy per se, but an emergency lifeline. Awareness of these programs can provide a crucial last resort, preventing foreclosure for those who have exhausted all other avenues. Always seek professional advice in such situations. The true aha moment for winning homeowners is realizing that a mortgage isn't just a static loan agreement signed once and forgotten. It's a living, breathing financial instrument that requires active management and periodic strategic review over decades. It's influenced by market forces, personal life changes, and economic shifts. Financial journalist Michael Lewis often highlights how the complexity of financial products often trips up the unaware. Understanding this dynamic nature transforms you from a passive borrower into an active strategist, constantly optimizing your position. This shift in perspective is the cornerstone of moving from the struggling 90% to the winning 10%. This paradigm shift from a mere borrower to a mortgage strategist empowers you. It means you understand the levers you can pull, how an extra payment impacts your total interest, when to consider refinancing, or how to challenge an unfair property tax assessment. It means not being intimidated by jargon but asking informed questions. You begin to see your mortgage not as a burden, but as a powerful tool for wealth building when managed correctly. The insights from behavioral finance confirm that control over one's financial destiny significantly reduces stress and enhances well-being. This journey transforms you into an informed advocate for your own financial success. To recap, your personalized mortgage blueprint for success includes several key actions. First, prioritize financial literacy and understand the PITI components. Second, meticulously manage your debt-to-income ratio and build a robust emergency fund. Third, choose the right loan product for your unique circumstances and consider a larger down payment to avoid PMI. Fourth, explore strategies like extra or bi-weekly payments to accelerate equity and reduce interest. Fifth, continuously monitor your mortgage, including taxes and insurance, and reassess your strategy periodically. These steps, combined, form a resilient framework against the pitfalls that claim 90% of aspiring homeowners. This isn't just about avoiding failure, it's about mastering your mortgage. It's about taking control, proactively seeking information, and making deliberate choices that serve your long-term financial health. Think of it as a masterclass in one of life's most significant financial commitments. The financial implications are too vast, and the stakes too high, to remain passively uninformed. Embrace the role of an active participant in your mortgage journey. This mastery will not only save you money but also instill a deeper sense of financial security and confidence, transforming your home into the asset it was always meant to be. It is an ongoing education. The future of homeownership belongs to the informed. As financial markets evolve and new loan products emerge, continuous learning will be paramount. Technology will undoubtedly offer new tools for monitoring and managing mortgages, but the fundamental principles of financial literacy and strategic planning will remain unchanged. Experts from the National Association of Realtors predict an increasing emphasis on financial education for first-time buyers. By adopting the principles discussed today, you position yourself not just to survive the mortgage journey, but to thrive, turning what is often a source of stress into a powerful engine for personal wealth creation. This is the new standard. The 90% fail statistic doesn't have to define your journey. By embracing the strategies and insights presented, you can empower yourself to join the winning 10%, those who not only successfully navigate the mortgage process but leverage it to build significant long-term wealth. This is about making conscious, informed decisions at every stage, from initial research to decades of payment and strategic adjustments. It's a call to action. Take control of your financial destiny, arm yourself with knowledge, and transform your biggest debt into your greatest asset. Your home can be a foundation for prosperity, not a financial burden. In the complex world of mortgages, your most valuable asset isn't just the bricks and mortar of your home, it's your knowledge. The more you understand, the more effectively you can manage, protect, and grow your investment. This knowledge is your ultimate equity, offering returns that far outstrip any interest rate. It equips you to adapt, overcome, and ultimately win the mortgage game. So, invest in yourself, invest in your financial literacy, and let your understanding be the foundation of your future wealth. The power is truly in your hands.